What is Freedom? Freedom is an algorithmic software system that produces daily trade signals for buying and selling stocks to consistently make money trading using Freedom. All you do is type 5 simple pieces of information into the homepage for the historical period you want to test. A stock symbol, a start date, an end date, how much money you would put into a trade, and how much your broker will charge you to make a trade. Then you press the Analyze button, the only button on the screen, and in just seconds, you get your signal and you're done. So, are you ready to take Freedom for a test drive? Sign up now for your
No cost, no obligation, no hassles.
14-day totally free trial. Freedom really is this simple.
So welcome back to our Traders Freedom one-on-one series. And we're very fortunate today to have the lovely and talented Ms. Rachel Williams again for part 2 of the session we started with her last week. And you'll be able to go back and take a look at that if you haven't already seen it. It'll be on our YouTube channel. But what we did was we started at the beginning because Rachel's never used the software before. And we walked through the main screen after she logged in, understanding the 4 or 5 buttons she needed to press to make things happen. Rachel, I think it's probably fair to say that using the software is really easy. I mean, it's not like there's a bunch of screens and buttons and things you got to keep track of.
The actual utilization and the pointing and clicking of the software is pretty simple. Yes, even I can do it.
So what we're going to get more focused on today is interpreting the data that you see.
Okay.
So we're going to log into the same account. Rachel will drive. I'll answer questions, and we'll see where we get to. But I think this is going to be fun. Rach?
Okay, so you want me to log in?
Yep. And boom, you're in, and that's it. So Rachel's logging into a test account here. Last week when we dropped off, she was looking at the stock that's on the screen right now, which is ATVI. It picks up all of the default values that she used the last time she was in here. It remembers the stock name, the investment size, the cost size, the start date that she was looking at. The only thing that changes when you log in is it's going to pick up the end date relative to the data that's in the system. So since Friday was the 17th, we've loaded all the data from the 17th in and run all our processing. So we'll have signals for Monday. This is the only thing that changes. It goes forward a day at a time. Rachel, go ahead, start driving and start talking.
Okay. I looked at a couple of the stocks that we went through last week. And specifically, I looked at ATVI and I looked at Apple. Just really process and understand what information I was getting. It just happened to be a really bad week for Apple. So either way, I'm glad I was just playing around because that's my favorite overall.
Which is good because there's going to be times like that. So knowing when the right time is, and this is something that you'll hear people say all the time. Oh, you can't time the market. You can't time the market. I don't think that's true. I think you have to have the right tools to time the market. But that's also why Traders Freedom is what they call a swing trading system, because it swings from long to short, long to short. And most of the time when they say you can't time the market, it's a matter of, well, you got to know exactly the right time to get in and then hope that it doesn't go down after you get in. Okay, if you're just going to buy and hold a stock, I guess that's true. But this system lets you take advantage of the fact that stocks go up and stocks go down. It's the natural state of affairs for every stock that's traded. There's no way to avoid it. So that's how this becomes a timing system, because it gives you signals for when to get in and when to get out or when to wait. So let's start with ATVI.
Got it. So you're making that common phrase about stock markets completely obsolete at this point.
Yep, I am.
Interesting.
It all depends on what your goals are and what the tools are that you're using to achieve those goals, basically.
Got it.
Okay, so let's take a look at that. So let's click on Analyze and let's see what ATVI has been doing for the last month. So tell me what you see here, Rachel.
All of the algorithms would have been better than if I had just bought and hold the stock. And so that was really good. Again, this week I was focusing on, I know you said probably whether it's like being conservative or aggressive, like using the number system, but I focused on algorithm 11. So I'm drawn to algorithm 11 right now for some reason, which again, seems to be kind of holding its own. So I might stick with my number with the system, but we'll see. As I learned, that could change. And so basically it was showing with, so what I would do now probably is just, which would have been a $320 loss if I just held the stock.
Right.
And any other outcome would have been much better using if I followed any of these algorithms.
Absolutely.
And then specifically for me, I want to look at, and again, I'll go into 11 and I'll click on 11 and I can just see how many trades it made, when it made the trades. And then this is where the trade analyzer button comes in, and I can look at that button as well and get a little bit more information, even like dig deeper into my analysis. So
trades, right.
let me hit that. And so on the trade analyzer, the information that I was really looking at was my average winnings versus my average losings. It looks really good. And in the last 10 trades, it was a 5-1 win over loss, which is also really good. Then I know there was something on the left that I should look at, but I forgot that from last week. So you can remind me about that.
Okay, so let me just back us up here. So let me just move this out of the way. ATVI is your stock, and you chose algorithm 11. So here in the algorithm summary box, it tells you, yep, you're looking at number 11, and this is how much money it made. Were to take those results and extrapolate them out so that if you could do this for an entire year, this is the percentage you'd return, which is great. And we just do that so that you can compare two models that have different length durations, or they come from two different time periods. It's just so it's like using a common denominator, so you can have some sense of comparing them more fairly. What's interesting at the top here is in the algorithm summary, as you said, 16 winners and 0 losers. That's pretty great.
And I think it's interesting now, that's something that I just learned. Again, I can look at it and actually look down the spreadsheet and look at the numbers, or I can just look up here and it tells me how many winners and losers over that time. So that's even easier information than where I was getting that information from, because that was like 2 steps of work for me.
Where the shortcuts are.
Mm-hmm.
Let's just close this up just for a sec here. So if we just go back, we reanalyze that. There's those answers right there before you even click on number 11.
Okay, so good. So that's even easier.
Yeah. And I mean, this might be what you scan because you have a certain idea of, okay, I only interested in stocks that have a certain number of winners. I mean, they're not always going to be 16-0. Mm-hmm. Every algorithm is not going to beat the pants off of buy and hold. But Rachel kind of establish a method where she says, I'm not really interested in anything that has less than 8 right and 8 wrong, or whatever the number is you're going to come up.
Is it a winner and a loser compared to just buying and holding?
Yeah,
that's what it is, right?
Okay. We've got all 16 algorithms here. So it wants to know for the algorithms, how many were winners or made money, how many were losers or lost money. And then if I just bought and held the stock during the same period with that $10,000, what would happen? Well, in this case, you would have lost over $300. Every one of these guys made money more than $300. Some a lot more money and some a little more money. But ultimately, it's 16 winners and 0 losers. Okay. And then if we go back to 11, which is where you were. So here's the trade details for the trades that ATVI 11 would have made. And so there's 6 trades, and we can scan the profit loss column and see that, oh, there's only one red. At minus 25, everything else was right. But as Rachel said, what she was really wanting to see was, okay, yes, the signal's out for tomorrow. So it's telling her, don't get into this stock, wait. So it's not saying buy it or sell it short. It's going, just wait, just wait. And it's been pretty right each time. It's got 5 winning trades here. But to see that deeper level of analysis, when you open that trade analyzer button, it shows you 5 wins and 1 loss. If you counted these up, that's what these would be, these 6 trades. So the trade analyzer drills into all those trade details and tells you the other things that Rachel just talked about, like how big was the average winning trade? How big was the average losing trade? Because that's like, I don't want too much risk here by buying something that okay, you may make $100 on a trade, but if you're going to lose 200 on a trade, maybe that's too risky. And that's what the trade analyzer lets you do. This guy looked great. The other one you looked at was Apple, right?
Mhm.
Okay, so in that summary box beneath the user inputs, what do you see?
So in the summary box, basically what I'm seeing is that there were many less winning algorithms and more losing algorithms with Apple. If I would have bought and hold, it would have been a win. However, that would have only happened, definitely not with number 11. That wouldn't have been a good one for me, but it wouldn't have been wouldn't have been as bad as number 5.
That's really important that you look at, okay, comparatively speaking, what makes me comfortable? And if I'm looking at 6 winning algorithms and 10 losing algorithms, that's like less than 50-50. Am I happy about that? But then when you look at the buy and hold value, and then you look at how much even the best algorithm could have made, it's not even close. So pretty quickly you could say, not a good month for Apple, move on to something else.
Right, but again, this is exploring. So this is where, how would I determine, like, let's say I had Apple this month.
Okay, so let's say for the sake of argument here, let's say you are making some money. So why don't we choose number 2?
Okay, so I'm going to go number 2. And then if I'm fed up with Apple, it's a good day to sell it on Monday. That's what the program is telling me anyway.
Right. Well, in the trade details here, you see they have 6 trades. But the clearest thing here is it's telling you, okay, based on all the signals we've had with this algorithm so far, on 12/20/21, which is Monday, short it, meaning sell it short, or if you're in it and you're not going to short it, but you just want to get out of the way of the risk, then you would make sure that you weren't in it, so you would get out.
So I would sell it.
And we can see that this trade, number 6, the one at the top, it started on the 16th. Friday was the 17th, so it was still in. It shorted the stock at $179. It closed on Friday at 171. So it's actually a profitable trade right now.
Mm-hmm.
So the only question you would have if you decided, well, if you were already in this, you'd have nothing to do because it's already short. So you would have got into it short on the 16th. And over the weekend, you look at the signal and it goes, no, just stay short. You're fine. You have nothing to do because you're just making money.
So then let's just say, though, that I'm shorting it, but that's not selling it. That's shorting it. That's different, right? Or that's selling it.
Shorting it is effectively selling the stock. The correct term is selling short.
Right.
Which simply means you go to your broker and you say, I'd like to sell the stock, but I don't own it. Can I borrow whatever, 100 shares of Apple? And they're like, yeah, sure. And then your goal as a shorter would be, I'm going to sell it because I think it's a bad time to be in Apple. And when the stock price drops down, which I expect it will, because you think it's going to fall, when you get a signal here that says go long, you would buy that 100 shares back, give them to your broker because you borrowed them in the first place, right? And then you would buy shares that you're going to keep for a period of time because you think it's going to go up. But with the short trade, you sold it at $179 and you got the money the day that you sold it after they lent it to you. Let's say you were going to get out of the trade at 171. So you buy it and you give it back to the broker. Well, you got the money at 179, but you only spent 171 to get it back to the broker. There's an $8 difference there. For every share you shorted, you'd make $8. So if you had 100 shares, you'd make $800. And then you buy yourself 100 shares and you wait to see it go up.
So if I wasn't in this stock on Monday, I could short this stock. I definitely wouldn't want to buy this stock until it flipped from short to long. Then I would want to get out of my short position and then buy the stock.
Right. Well, if you were already in it, so you're short, right? If you're thinking about, is this a good time for me to either go long or short? It's telling you go short. If we look at the summary above it, it's saying of all 16 algorithms, none are long, 15 are short, and 1 says just stay out. So there's a lot of precedence here to say you should be short this stock.
Mm-hmm.
The thing that you need to think about as a trader, though, is when you open that trade analyzer for this, okay, and we look at those averages here, yes, the average winning trade is almost $387. The average loser is 253. But I have 4 winners and 2 losers. If I win twice for every one I might lose, that's great. I would take that, right? Especially because the money that I make going in and making a winning trade is almost twice as much as what the losing, not quite twice as much, what a losing trade is. But the other thing that the trade analyzer shows you is, okay, that's good, but what's the average number of days in a winning trade as opposed to in a losing trade? So if I'm thinking about getting in a trade that seems to be winning, and if I look at the number of days here, it's already 2 days old. If the average is 375, is this kind of getting a little long in the tooth for me to get into this trade, or should I wait for the next one? Because I don't want to get in right at the end and then tomorrow have it, the next day have it say, okay, flip around the other way. You might be a little late in this instance, simply because the trade's already that old.
Yeah. So sometimes it's still the entry, whether it says short or long, depending on how long it's actually been in that position, it may or may not be the right time to go in. If you're looking to if we're really looking to time the market with this program.
And in this instance, timing is everything. But the thing is, you have access to information that most people don't unless they're using the software, because all of the data in the trade analyzer and all of the data for all of these different models, those are all proprietary models that are only available on Traders Freedom. So you're the only one who's going to see this data. So if it was me and I was doing this, I'd think, okay, it says be short, but it's already 2 days long. And the average number of days in a winning trade is a little less than 4. And in a loser, it's 3. Well, tomorrow's going to be the 3rd day. I think I'll wait for the next signal.
So probably the best, if you're looking to get in on a stock to start with it, the best time is the day that the system flips to something that it hasn't done before.
Flip date, exactly.
A flip date, okay, right.
And
or a flip position, really. It's a date where the position flips is like a great day to start.
Right, and if that was true, and it is, I truly believe it is, because we've done all sorts of testing to find out what's the optimal day that you should be getting in, and it always comes back, like I think the last time we ran the test against all the stocks over a period of time, it was like 72% of the best trades were on the day that it flipped. Okay. So what that would mean here, what you would have seen is, if this was a flip day, it would have been in a 2-day trade that was long, but the signal for the next day is short. So this tells you it's the flip day because the position here is different than the position.
So for me, getting started, I want to choose my stock, think about the algorithm, randomly or not, that I want to follow. And then I want to kind of just be patient and wait for a flip day. Would probably be, because you said 70-something%, it's better. So then that would be my best point of actual entry into a position.
I think so. And that's not me telling you what you should trade or how you should trade it. That's me just saying, based on using the system, about 70% of the most profitable trades were ones that people get into on the first day when the signal flipped.
Oh, well, that was good learning for today. Then that was definitely something I didn't get last week.
Okay, let's close the trade analyzer and let's stay in this guy here. Let's just reanalyze this so that it's like we haven't picked. That's not really a compelling reason for me to start trading a model, especially if 10 of them, the ones that are red here, all lost money. So let's say Apple's not good. So let's go back to ATVI because that gave us more to work with. And here, again, 16 winners and no losers. That's pretty spectacular. A loss of $320, which means you could have thrown a dart at this board a month ago and made more money than that. Is pretty great, but that's like the far extreme of what you expect, which is, hey, I only pick stocks that have 16 winners, right? I mean, that might be what you try and it might work for you. Like I said, there's 11,000 opportunities, different stocks trade every day. And there's 16 algorithms, so you got like 175,000 possibilities there that you could choose to trade. So when we looked at this, you liked 11. We already talked about net profit loss is just how much money. Number of trades is easy to understand. If you wanted to trade just a little, you might choose one that only has 4 trades. If you're not worried about that, all of these look like, a bunch of them made 6 trades. So if you're not worried about how many trades you're going to make, that might be a compelling reason for you to say, choose one model or another. Every one of them made money on their long trades, except for these 2. Everybody made money on the short trades. And if you look at those 16 winners and 0 losers, for Monday, 4 out of the 16 say you should be long. 1 says you should be short, and 11 go, just stay out, wait. So you'll get a different set of signals on Tuesday. The one thing we haven't talked about yet is these 2, DD and max DD. So this is telling you how much money. This is telling you how much money if you annualized it. These are showing you long money and short money. But these guys, drawdown and max drawdown. This exemplifies your risk. What you see here is a whole bunch of zeros, meaning there was, for these models, in this time period, just from 1117 to 1217. And then number 5 had a 1.28% risk, and number 4 had the most at 4.2. So drawdown's a really simple concept. So what drawdown represents is the largest loss this model experienced during this time period in a single trade.
In one trade.
Yep. So all of these guys had no losses. These guys that are the 0.22s have minor losses.
Okay.
Then we got these guys who have no losses. This guy had a 1% loss. These guys had zeros, and this guy had a 4. So this is the riskiest one because he actually took a 4% loss at some point, even though at the end of all his trades, he's still up 100. Looking up and down this column, that might be something that is part of your decision-making as far as which models you're interested in. Not that you're always going to find ones that have 0 losses, but you need to decide as Rachel, the trader, how would I react if I had a trade that in one trade, it dropped 4%? You okay with that? Does that sound a little overwhelming? That's a question over time only you're going to be.
With the max drawdown, how is that relative to the drawdown?
Okay, so maximum drawdown. I'll just say this again. So drawdown is the most you would have lost in a single trade because it flipped from long to short or short to long. Maximum drawdown is the largest drop during a single trade that you would have felt, but the system didn't signal you to get out, so you never closed that trade and it managed to recover, at least somewhat. It might have taken a loss. Okay, I'm in
If
this
I was
trade.
looking at the stock that day.
Yeah, like I'm sitting here and I'm looking at this and I'm in this position and I've been long or short for however many days. And the position's going against me. And now I went from like down 2% to down 5% to down 8%. This guy here, the biggest winner, actually at one point, one trade was down almost 11%. That might make you a little nervous.
How could it be down almost 11%, but then on the drawdown day, it was at a 0 still?
Great question. You're right on target here, because think of it this way. I get in the position like this, and it goes up a little bit, and I stay in the position because I have a signal that wants me to stay. And then it turns around and it starts to go down, and I'm like, okay, well, it's going down, and then it keeps going down, it keeps going down, and you get to that 11%, and now you're like, oh, this is an 11% loss. What's going to happen? And then the stock turned back up and then started to go back in the direction you wanted it to go, and then actually exceeded where you bought it from. And by the time you flipped it, it was a winner.
Okay.
But you experienced that dip. And the way that I like to describe it is it's like a roller coaster. So when I asked you, is a 4% loss, does it seem like overwhelming? And you're like, no. But is an 11% drop going to give you an ulcer? Because you're sitting there going, oh my gosh. That's the deciding factor, right? So you
what
might.
What about for me if I just don't look at either of those columns, so I don't have to get that emotional attachment during my trading?
You could, but then again, you probably want to pick models that you can live with and not have to get freaked out by. If you're thinking about getting in the stock tomorrow, the time period that's most relative to that is last week. What happened 3 months ago, just like the weather, what the weather was like in August has nothing to do with what the weather's like in December. So going that far back, I don't know that it would necessarily help you all that much.
So
And
somewhere like a week to a month would be a good amount of time to kind of get my volatility thermometer
yeah,
accurate.
I think a week might be a little short because you might only see one trade in a week. Because if the trade's 5 days long, if you're looking for a trend and there's only one point, I don't know how you connect the dots. There's only one dot, right?
Mhm. Okay,
Um,
so a month is probably which is what we're looking at now. That's probably a really good amount of
that would
time to look.
like let's use this stock as an example. So you got a bunch of zeros and a 10, and your 11 was a 0.22 loss and a 7.65. You took one loss here that was tiny, and you had one dip that was average, much more average than the guys who were all above 10. So this would probably, as a model, look less risky because it's not going to bounce down or up or around so much that it's going to make you anxious. And you got to live with this stock as you're trading. So maybe that would be why you would pick number 11. And if we look at number 11 here in the trades, all of them made money except this guy who lost 25 bucks, which is that one drawdown loss that you see right here at 0.22.
Right, right.
Because you started with $10,000 and that's what it equals. But at some point, one of these trades, probably this one, dropped down 7%, but then came back up. So even if you got out with a tiny, tiny loss, you would have had to ride the roller coaster enough to feel the dip as it's going. And the thing about drawdown metrics, and again, the analogy of the roller coaster, I think is the best one I can come up with. If you knew, oh, I'm going to ride this ride that I know has a dip that's not too bad, but I've been on it before and I know what to expect. That's the 0.22. For the last month, I know that it's a 0.22. If it happened again, I could deal with it, right? So you get on the roller coaster, you enjoy the dip. Maximum drawdown is like getting on a roller coaster you've never been on before and you don't know what to expect. So in the middle of riding that coaster, as you're racing to the bottom and you're going around that curve and you feel your stomach kind of go, that's kind of what maximum drawdown is. And if that big a dip is something that unsettles you, then maybe you stay away from models that have an 8% to 10% to 12%, whatever number you come up with.
Mm-hmm.
The smaller the maximum drawdown, the less volatile it is intra-trade, because you're in it as it's going up and down, but you didn't get a signal to get out, so you didn't take the loss. The drawdown is simply over the time period you had, what was the biggest loss you've been taking because you'd flipped.
Understood.
Okay, so let's remember what that value is, right? So number 11, 0.22 and 765. To where we had, we changed the end date to where the start date was before. We just look at that month before. And that's a really important thing about this, that we're looking at the last month and what to do on Monday. So if this was a month ago and we were doing this, and you put in ATVI from 10:15 to 11:17 to look at a month's worth, and you hit that analyze button, there's only 2 winning algorithms and 14 losers. Algorithm number 11 was second worst.
Mm-hmm.
If we were having this conversation a month ago on 11/17, you would have said, there's nothing here that makes me feel good. I'm just going to go on to something else.
Mm-hmm.
Right? That's the beauty of the system, because you can shift time like that very easily to do your back testing to see, okay, if this was a month ago, would I have chosen this?
And I would not have.
Looking at this right now, the answer is no. If we did the same thing with Apple, AAPL, you got all these things that made money.
Mm-hmm.
You have a little bit of risk on losing trades, like 2%, 1%, 2%.
Mm-hmm.
Maximum drawdown is all less than 5. So that's much more comfortable than what we saw on ATVI, is really volatile. But you, by using Freedom, you have a view into that volatility that might steer you clear, because it just didn't look like there was anything but a lot of volatility with some losing trades. Even if you bought it and held it, you got killed. This one, if you bought and held it, you made $693. So let's say you like the number 11 here, a 1% loss, a 4% dip. You got 7 trades. It looks like the first 1, 2, 3, 4, 5 were all winners. Last 2 were losers. So is it starting to head down a losing road here? Is this enough for you to say, I don't love that? If I look at 16, the guy that made the most money, I got 1, 2, 3, 4 losers, but a lot of winners. And the drawdown and the maximum drawdown is not that bad.
Mhm.
So that's number 16. So let's say it was a month ago and you chose Apple 16. If we reset those dates to the latest month, choose 11/17 to 12/17. And if we had picked Apple 16 this month, you would have done that. You wouldn't have made a lot of money, but you would have made some money.
Mhm.
So you need to look at things from the perspective of, would I have picked this stock a month ago? Because if I'm going to pick it tomorrow, based on what the last month looked like, how would it have done if I picked it a month ago? Is there some consistency to the pattern that that algorithm is picking up? And in the case of Apple, there was. In the case of ATVI, there wasn't. So those are really important concepts that to get hold of, which is what risk means. It's drawdown and it's maximum drawdown. So this is the dip that it took based on when the trade ended. This is in the middle of that bad trade. How much deeper did the dip go?
Got it.
Let's grab another stock.
Let's go back to Disney. How's that?
Okay, so in the algorithm summary box, right under that analyze button, tell me what you see.
Okay, so I see that if I just bought and hold it, it would have been a loser. I see, though, that there were many more winning algorithms than losing algorithms, 12-4. And I see on average, if I just bought and hold, it would have been $530 loss. But any of the algorithms, I would have done better than that. And the most money I would have lost would be $297 with an algorithm, but I also could have made up to $1,207 following any of the algorithms that well.
And as far as tomorrow goes, because we're always thinking about tomorrow, right?
So for tomorrow, I would want to pick the algorithm that I would, which let's go back to number 11.
Oh, wait a second. Let's go just back up to the
Sorry.
summary here first. So as of tomorrow, again, for all of the algorithms start for Monday, 3 are saying buy it, 3 are saying short it, and 10 are saying just stay out. So that's pretty overwhelming as far as what all of the algorithms are saying.
Right. So
we're only going to choose one. So in your list of algorithms here, what was the one you liked the best? 11?
Yeah.
So let's go ahead and click 11. It happens to be out like 9 of its other brethren.
How do you, oh, okay, because you see it on the screen on the right there, okay.
Yeah, on the far right side. Yeah. So there's your big yellow banner. Stay out. If it was go long, it'd be green. If it was short, go red. And if it's out, go yellow. So it's just like traffic lights, green, red, yellow. So you have an out signal for Monday. And if you look at the trade details beneath the trade analyzer button, tell me what you see in those trades.
This algorithm traded a lot of 2 and 3 days. It's in a short, which isn't out right now. And so possibly after tomorrow, it might switch. So that might be a better day to get into this stock.
Yeah. So it was short. That fifth trade, the latest one, started on the 14th, went to the 16th, and it was short, but now you have an out. So this is a flip day, but it's a flip from short to out.
Mm-hmm.
And this is the one guy that lost a little money. Everybody else made.
Perhaps Tuesday or Wednesday or Thursday of this week would be a good day to start shorting or longing the stock, depending on when the algorithm switches signals next. So this
and it could flip back to short. Like if you look in these positions here for the first 3 trades, it was short and then it went out and then short and then it went out and then short and then it went out and then had one long and then it flipped to short and now we're back to out again. Let's look at number 2. Has 3 trades. It went short, long, short. If we look at the dates, it goes from the 18th to the 26th, from the 26th to the 16th, from the 16th to the 17th. And if we look at the trade,
you were in it most of the time, all of the time. Yeah.
100% of the time.
Mm-hmm.
But it had 3 winners and 0 losses, and it was just always right.
Mm-hmm.
And again, this is tied into how the model trades, the freedom model, which is, again, a model is a stock name and then an algorithm number. So this is algorithm 2. So this would be Disney 2, DIS2.
Mm-hmm.
And it was the best performer. It made 3 trades. It made money on longs and shorts. It was trading 100% of the time, but it only made 3 trades in the month. So you see the average number of days in a win is 7. If you look at the average number of
I want to
days.
look at Disney a lot. Well, I wish I was looking, if I had started this a month ago, then I would have been really happy if Disney was the stock that I picked out of all of those other ones.
And you
right?
really would have had virtually very
A
little.
super amount.
Here's a 5-day trade, a 14-day trade, and a 2-day trade.
Mm-hmm.
But that algorithm is really conservative, number 2, and it's going, you really have to convince me to change my mind. And it went short for 5 days, and then it said, go long. I was like, I'm staying here until you really convince me that I should get out of this trade. And that's why it has done as well as it has. Because Disney right now, this has been a great approach. But we did 2 things here. What you did is you looked at the drawdowns and the maximum drawdowns, and they didn't look as intimidating as ATVI did because it's not as volatile. It's Disney. It's not going to be as volatile, right?
Mm-hmm.
And then it was a matter of picking which algorithm matched up best with your approach. And when you looked at 11, just had one trade that didn't do all that well, the last one. And when we looked at the trade analyzer, it has a lot of outs because it's only in 57% of the time. So again, it's looking for a very specific thing before it says time to flip. You had 5 trades over that period of time, and the average number of days in a winning trade is 2.5, and the average number of days in a loser is 2. And these trades were all around 2 days. So right now it's going, not yet. So you're going to wait until it actually tells you to go long or go short.
Got it.
Because it's been successful doing that for the last month. I remember somebody once saying, and at one point he said, there's only 2 things that ever happen in the stock market, greed and fear. He's sort of right. Because the first thing you want is you want to make a profit. That's why you're in this.
Right.
But what can stop you is your fear that this isn't going to go right. But that's, again, why a system like Freedom, which is trying to help you not be so fearful and pick the right profit opportunities, rather than just watching it drop 20%, if you short the stock, you make money. And if you can avoid by evaluating, okay, how much risk is actually in this? We looked at the drawdown and the maximum drawdown.
Mm-hmm.
And you got a sense of
That's
where
your safety net.
that's the riskiest guy here. When we looked at ATVI, yeah, they made money, which is great, but how much risk are you willing to take?
Mm-hmm.
Is that 10% dip, almost 11% dip, going to cause you to have so much fear that you end up popping a bunch of Tums, or because you're sitting there that, the night that it's down that long going, oh my God, I can't believe I might get 11% loss. You still have a signal that says, no, stay in the position. And you're like, oh, I don't know. So 10% might be too much for you, or 10% might be fine for you because you're Rachel.
How long does it take someone to use your system to just have faith in your system? Whereas these metrics wouldn't really change. I'm just going to say, you know what? I'm just following the system and I trust in it. I believe in it.
But you have to decide what data matters to you. You might never, ever look at drawdown. It's entirely possible.
Well, isn't when doing this, because the objective is to make money, isn't the data that I'm looking at, am I making money? I mean,
it is. But if you think about it more so from, just think about it from a Rachel perspective. Okay, so you're like, I'm in this to make money. And this is the one that did the best. So I like 16 the best. So I'm going to do that one. And then you click on this and you see money, 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 money. But during this month, so let's take 11/17. Let's go back to 12/3. So we'll go back 2 weeks. And it's rule 16. And I click analyze. Well, here's 16 way down here.
Mm-hmm.
It's up, but it's not up as much as all these guys, because at some point that one trade that it was in stumbled, and then you're hanging in there and it starts to recover, but you experience the stumble. These guys didn't, because their drawdown was like 7%, not 11%. These guys were even less. They're down in the 6s. So I think most people, including Rachel, would feel that. So if you have access to some way to evaluate how bad could this get, that's only going to help you. And again, this isn't us saying, well, we believe based on volatility that this is probably what you expect. Or you'll hear people say, Well, you have to be ready to withstand a 7% loss. And if you have an 8% loss, you should get out of it because that's bad. Freedom focuses on just the ATVI fish. There's no universal truth here, right? ATVI's risk during this period, let's go back to 17. ATVI's risk, the most risky one, if I just click on the header here, is 10.8. 10.8 is much more than Apple, much less than Apple, actually. But when we look at the drawdown for the last month, Apple's drawdown was much worse than ATVI's. Look at that, 18% drawdown. The other one you were talking about was Disney. Same period, its worst drawdown was 10 and got much less. So it was less than ATVI and much less than Apple. So being able to understand what these risk levels are, again, drawdown is like, what's the biggest loss you took in a single trade? Maximum drawdown is what was the biggest dip? And it probably was before that losing trade. Not necessarily, but probably. So how much of that volatility could you take as you're riding a roller coaster that you don't know when it's over or what's around the corner? Okay, let's pick a different stock. And I'm going to show you something else.
Okay. Let's pick Amazon.
Okay.
Okay, there we go.
Let's go back to what it is by default, which is show me the net P&L. The biggest winner at the top. We got 9 winning algorithms and 7 losers. If you bought and held it during the period, you'd lose $300. For Monday, 3 algorithms say be long, 3 say be short, 10 say be out. So a lot of outs. And if we look at, we start at the top and go down through the 16 algorithms. On the far right side, we see the most profitable one says long, and then 2 outs, and then a long, and then a whole bunch of outs. So if you were following this, you might say, okay, 4 made the most money. It happens to be long on Monday. What's its risk look like? It's got a 0 risk for drawdown, so it's never had a losing trade that killed it. But at some point, it took that almost 6% dip. Can you handle a dip of 6% if it recovers? Probably. Much better than you could if it was 16%. So if we click on this algorithm, we knew that there were no losing trades because I had a 0 drawdown. All 5 of them made money. And when we look at your trade analyzer, it was in 21 trading days, which is 100% of the time. It had no average losing trade because it never lost. Average winner was $190. Its average days in a winning trade are 4.2. And right now it's only 1 day long. So if you decided to get into this, you'd be getting in on the second day, not the first day when it flips, because it flipped on
Friday.
On Friday, 12/17, right? So you only missed a day. That's not too bad if your average days in a win is 4, because all right, well, it's got some time that it could go further up. We see here, now it's really expensive. So it went from $3,354 to $3,400. So it went up $60, which sounds like a lot of money, except you only have 3 shares because we started with 10. So it definitely has room to go percentage-wise. If its average winning trade made $190 and it's up 138 right now, you've got a lot of winners that are bigger than that, 385, 251. So this might be worth getting into, but it's not at the flip point.
So either I would have wanted to get into it on Friday, or probably it's better to wait a few days till it flips next.
Yeah, if you had been trading this all or tracking it last week, the 13th was a flip day, the 17th was a flip day, the 6th was a flip day. So it seems like 6 days, 4 days. Yeah, maybe you wait for the next flip. Or like I said, if you really, really like the stock and you're like, it's only 1 day in, it might go 8 or 5 or 4 days. I'm willing to get in and take what I get the rest of the trade because it's really close to being. And I think I can handle the drawdowns because there's your drawdown. It's a 0 drawdown, so it's never lost. And its biggest dip was 5.8%. If you were comfortable with that, you might do that. Okay, so before we click on the additional analyzer button, I think one of the things that drawdown also gives you a sense of is if we look at all these drawdowns for these models here, you've got zeros, twos, threes for the biggest losing trade. In maximum drawdown, you've got a 6, a 5, a 5, a 7. So not terrible. These would be numbers you'd look at to prepare yourself to say, if the trend of this stock, the way that it's trading right now with this algorithm continues, could I handle a dip of 7%? And you might say, yeah, that's not the end of it. If you decided to trade Amazon, I don't think it's realistic to say, well, if it ever loses, I'm getting out of that model altogether. Yes, in this month, it happens to have 5 winners and 0 losers, but that's not a realistic objective. But one of the things you might look at over time is, let's say you traded this between December 17th and January 7th. If, as you're trading, you see that these numbers start to go up, let's say the dips go beyond 6, 7%, single losses go up between 3 and 4%, maybe they reach up at 5. What that's telling you is the pattern of the trades is changing. So that might be the point where, and Rachel and I were talking about this the other day, how do you decide when to stop trading a model? It might be profitable, but what makes you say, I'm going to look for something else. I'm going to cash in my chips. I'm going to go someplace else. That's where I think drawdown and maximum drawdown are also really helpful, because they're letting you see the underlying risk as you go forward. It might still make money. You might still be profitable, but how much risk or how much uncomfortability you're experiencing as you're going along, if it starts to go up, it might be an indicator of something that's about to happen. And that might be a deciding factor for you to say, that was good. I made money. I'm good, but I'm going to go back into the system and look for something that has better drawdowns and max drawdowns, because this is feeling a little overly volatile. Okay, so the other thing I want to look at, and this is much simpler than drawdown and max drawdown. I'm really glad we did this because it's a really important concept. Not something we invented. It's just something we track every single day, and you're never going to see that anyplace else. Across the top here, there are 4 other analyzer tools. So we have the trade analyzer here, which we've looked at, we talked about. And the one that I want to talk about is called the trend analyzer. So if I open that up, what this is telling me is, for this specific stock, so this has nothing to do with Freedom's models. This is just the stock. What's the trend for this stock right now? So it's saying Amazon on Friday, it went up, and it's in a one-day trend. So it just went from being down on Thursday to up on Friday. If we look back over the last 500 days, just for Amazon, from the end date that you selected, and we used Friday as our date, it's gone up one day 124 times. It's gone up 2 days 71 times. So if you look at that and you take 71 and divide it by 124, it would suggest that there's a 58% chance that Amazon will be up on Monday. So if you knew that, it might make you say, all right, and it wants me to be long, I'm cool with that. But the trend analyzer also tells you how many times it was up 3 days. It was 42. So if I take 42 divided by 71, there's a 60% chance that it's going to get to 3 days. That might make me feel better about making a long trade. Or you may ignore it altogether, but it's here, and you have the freedom to use it. It looks like the tough day for Amazon is the 4th day in a row. There's only a 40% chance that it's going to be up 4 days in a row once it gets to 3. But if it gets to 3, if it gets to 4, then there's a 53% chance that it gets to 5. Again, that's a nice roll. This is where the sticking point is. If it gets to 5 days in a row, it's only got a 33% chance it gets to 6. If it gets to 6, it's only a 33% chance it gets to 7. And if it gets to 7, there's a 0% chance it gets to 8, because it's never been up 8 days in a row in the last 2 years. So if you knew this, in addition to the signal you have, which says go long, in addition to the 5 wins and 0 losses, in addition to the drawdown, which is the drawdown's minimum and the biggest dip is 6%. Let's say, for example's sake, Amazon have been up 7 days in a row, and there's a 0 chance if it's going to be up 8, but you have a long signal. You might, as a trader, say, you know what? I will cash in my chips because I don't expect the most unlikely thing in the last 2 years to happen to Amazon. And that data and that information is right here. Once you do your analysis, just by clicking on Trend Analyzer, it'll show you all the uptrends here. It'll show you all the downtrends here for the last 500 days. Sound like something you care about, Rachel?
Well, I think it's something I care about more if I'm deciding to go in or out of the stock.
Absolutely.
And I'm looking to time when I'm going to go in or out of the stock. So I can look back and say, well, it's done at this, and certainly the days where it's well above 50%, and my chances are much better that it's going to continue. So I think this is a good one, actually. If I'm in the stock and I'm deciding, like, for some reason, do I want to go out of it or jump in? And if it's in the middle of in the midst of one of its flips, if it's in the middle of one of its cycles and it's not on a flip day, this is also a really good piece of information to help me decide if I'm not going to wait for a flip the day after a flip day, if I need to do something more immediate.
And that's a great point, because as we looked at already, it's been in this trade for 1 day. And we know from looking at the trade analyzer that the average days in a win is 4. If you were to open the trend analyzer and saw, okay, it's in a 1-day uptrend and it's got some legs here that it could go. So if you want to get in on the second day, you'd say, okay, there's nothing here that's stopping me. There's nothing here that says, oh, I'm not so sure about that. But if it had been up 7 days in a row and you just had a 2-day trade, you might think twice about it, because you get a sense of what's happened with this stock or not. And again, it's specific just to this stock, just Amazon. It's just the last 5. Let's do the same check with our other.
Can we look at Disney? Because that was the stock that I'm really interested in now.
EIS, keeping the dates the same, 11/17 to 12/17. Investment size exactly the same.
Okay.
And which algorithm do you like the best?
Well, do you have to ask that question anymore, John? Come on.
Go ahead, click on it. It's telling you stay out right now.
But then if I want to get an idea, let's say I really want to get into it, I can look at the trend analyzer.
Well, let's look at the trade analyzer first.
Oh, the trade analyzer first. Okay.
So with the trade analyzer, it's only in 57% of the time. There's a lot of outs. Your signal is out, right?
So I could be out for many more days.
Yeah. But now what we want to know is, okay, so this is telling me about the trading model, Disney 11. Now let's look at the trend analyzer to look at Disney, the stock. It has nothing to do with the models. It's just the stock. So go ahead and click the trend. And the trend analyzer says it's in a 1-day uptrend, but the signal's telling you just stay out. So as far as the odds of that uptrend continuing, it's about 45% that it's going to keep going up. And the next day it's 49%. And the next day it's 33%. The law of diminishing returns, day 2, 3, 4, 5, it doesn't seem to have really strong uptrends. But again, we've just got a 1-day trend here.
Mm-hmm.
So it is, could it get to 6? Sure. It's got a lot of 45, 49, 33, 30 before it gets to 67. So the trend analyzer kind of agrees with what you're seeing here, which just stay out until it really gets a little more confident. So your signal for Disney Monday, take that part of the $10,000 you have. Let's say it's $5,000. You just park it and you wait.
And then that would be if I so let's say I was in Disney and I got out, this would be a good day if I said, you know what, I've been fed up with Disney.
It depends on how long you've been in the stock, right? If you had been trading this and you had a winner, a winner, a winner, a winner, and a little loser, is that enough of a reason to get rid of Disney just because the signal says out?
Right.
Probably not, right?
Probably not.
It's a pretty good winner.
Because overall, this one's been pretty good.
So I would just park the money and let it sit there. Let's look at your ATVI example. Okay, so this was 11 as well, right?
Mm-hmm.
So let's go ahead and click on 11. So it was in that long for 4 days, the 14th to the 17th, and now it's out. So it's waiting for the next good opportunity.
And it still says for Monday to be out.
Right. We look at the trade analyzer. It's in 66% of the time. So there's a bunch of outs in this too, but 5 winners and 1 losers. That's pretty great. And if we look at the trend analyzer, it was down on Friday, the stock, and there's a 44% chance that it's going to be down on Tuesday, followed by a 43% chance it'll be down on Wednesday, and then a 52 that'll be down on Thursday. Then that's the bubble day, which is the next day, which is a 38% chance. But then it goes 60, 100, 66, 50, 100. And look at that. It keeps going down, 100, 100. If it gets to that 5th day, it seems like it has a lot of downward.
Mhm.
On the upside, it looks like, okay, it gets through 1, it gets through 2, 3 and 4 are kind of questionable before it gets to 50-50. And then you got 100 here, 33, 100. It like tails off there, but there's a lot of momentum. And you kind of know that because, as you said, if you look at the buy and hold, if you bought and held it, it just loses money. So it seems like it has a lot more down days. And when it is, it's a lot more ferocious as far as it's down.
Right. So I know with this stock and this model, I'm going to be doing a lot more in and out and swinging.
So the combination of those two things, the trade analyzer being the way that the model is trading, ATVI algorithm 11, is telling you about the model and the signals. How well is it tracking the stock? The trend analyzer tells you just about
The stock.
Independent of what model you chose, it's just telling you how the stock's trend tends to develop. What's the chances based on history that it's going to be down a second, third day, fourth day? How bad does it get? Sometime in the last 2 years, ATVI dropped 11 days in a row.
Yeah.
But once you got to the 11th day and you knew there was a 0% chance that it was going to hit 12, the algorithm is going to continually say, based on what I'm seeing, I think it's short, 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 short. Well, here's the additional piece of information that you have, which is, okay, that's the algorithm talking. Stock talking says, okay, I'm down 11 days in a row. I'm not getting to 12, at least I haven't in the last couple of years. So this
Right.
might be the point where you cash out and say, I've made a ton of money. I'm just going to get out of my position.
And move forward.
Be a happy camper, wait for the next signal. So this is all accessible from the same screen. And you're only effectively pressing a couple buttons. The first one to analyze the stock. And look at the trades here. And if you want to look deeper into the trades, you click on the trade analyzer button there. And then if you want to look at the stock trend, you click on the trend analyzer button. And it shows you all those stock trends for just that stock. So it's just algorithm 11 and it's just ATVI.
Are all of those 4 buttons, the data, trend, risk, and chart analyzers, relative to the stock itself? And the trade analyzer is the one that's relative to the algorithms?
Correct.
Okay, got it. So if I want to do some statistical analysis of the stock itself, I'm going to look in one of those 4 buttons in the center. And if I want to do some analysis within the algorithm system, I'm looking at the trade analyzer. Okay.
The trades would not exist if you didn't have freedom in the algorithms.
Right.
But the trend of the stock exists because it trades.
Right.
The risk analyzer works because it's relative to that particular stock. Did we look at all of your stocks with both of these things?
We didn't look at Apple yet.
Okay, so let's do that.
Okay.
APL. Okay, so again, analyze button. Look at the results. 11's down here. It's a loser. You really want 11 here, Rachel? To
Just
see
for
how-
giggles? Sure, just for giggles, let's do number 1, because that's
It
11.
only has one trade. I don't know that's going to tell you much.
Okay, let's do number 2 then. Let's do number 2.
We're never going to tell you, look at this stock or pick this model.
And certainly don't let the viewers let my stock choices influence which ones they're doing, because
By the time they watch this, we're just talking about December 20th, what to do then, right? All of this is history and everybody could go back and reproduce everything we're doing here. That's really important to understand. So we see Apple with your $10,000 has 15 are short, 6 winners and 10 losers. Number 2 is the second best algorithm because at least it made 6 trades. So just for fun, let's say you had $1 million. Okay?
that's fun.
And let's do analyze. Look at this. 6 winners and 10 losers, 15 are short. Algorithm number 2 is the second, and it made 6 trades. I don't care if you're Rachel with the money that she has, or somebody who's just starting out and says, I can only put $1,000 in 2 stocks because I don't have a lot that I can risk, or some big ticket guy who's got a lot of money and says, I'm going to put $1 million in 3 stocks that I like. You're going to get exactly the same signals. You're going to get exactly the same number of trades. They're going to be for the same duration of time. The dates will be the same. Everything's identical. The only difference is you're going to buy more shares because you started with $1 million. This flattens the playing field because all of the artificial intelligence that's in Freedom works exactly the same whether you've got $1,000 to trade with or $1 million. Let's go back to reality here and $10,000. We're going to go with 2 and those 6 trades, and back to reality, 65 shares. What we see here is does pretty well. Its risk is 3% losing trade and a 10.5% dip at some point, which was probably this biggest losing trade. So this could have been at one point $1,000 loser.
I have a question actually. So
Sure.
just that I hadn't thought about. So just getting started. So let's say I get in on 11/18 for Apple, then I'm out on the 29th, right? And I have 65 shares, positive money, right? I've made $359. When I go back in on the 29th, I'm assuming now it's not having me invest in with my original $10,000. It's having me invest in with my 10,000 plus my 359.
That's good. So yes, it uses compounding. If you made money here, the next time you make your trade, it's 10,359. So it reinvests your profits or takes away to accommodate your losses. So the Apple portion of your portfolio would now be worth $11,043.
Got it.
And you could go back, and I think this is important too, because people are like, well, could you really have bought 65 shares? And is that the price you get? If you go back and look in CNBC, Bloomberg, Yahoo Finance, Google Finance, whatever, if you look up the opening price on 11/18, it was $153.70 exact. If you were to try to buy 65 shares, and Apple trades, I think, like 32 million shares a day, I don't think you'd have much trouble getting filled with 65 shares at all. Similarly, if you look at 11/29, the opening price would have been $159.23. So within pennies, you could have sold your 65 shares. And maybe you made $357, or maybe you made $362, depending on what these exact to the penny prices were. But it's going to be awfully darn close. And if you want to make yourself feel good about, is this for real? Go back and look up these opening prices, always opening prices.
So you're just automatically doing your buy and your sell at the opening.
At the end of the day, you look at your signals at 7:30 at night and it says, buy this tomorrow. You put in your order right then and tell your broker, buy this when it opens.
And you're going to buy it for whatever the market price is. You're not going to muck around. You just buy it at the opening price.
Correct, because this was the opening price. And if just buying in the opening price, which is what this did here, and selling at the opening price managed to make you $1,000 on a $10,000 investment a month,
that's good.
There's no reason for you to quibble with, well, but I could have gotten a better price. I mean, you could if you want to quibble, but this is supposed to be quibble proof and not tie your life up, right? So at 7:30, you go, oh, I got to buy this tomorrow. You put in your order, you forget about it.
And then that's
So
it.
30 the next night, you check it again. For 6 nights, once you got into that long trade, it just kept saying long, 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 long. From Monday to the following Tuesday, you had nothing to do other than check the signal. And then on Tuesday night, it said you want to be short. So Tuesday night, 7:30, you said, okay, put in an order from my broker, sell this, and I want to short this many shares at the opening price. It's done. Forget about it until the next night. And then for 5 nights in a row, you had nothing to do because it said short, 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 short.
Got it.
But you don't have to be somewhere where you could sneak out of your office and, oh, it's 9:25. I got to put my orders in. Every trade we make is at the open, and you take the open price. You don't muck around with, just say at the market. We don't play around with pre-market. We don't play around with aftermarket, because the volatility there gets nuts because it's the volume's so thin.
And it's great because it just simplifies things. I just know the night before I have to put in my trade and it just is done. And so I don't have to think about anything except just the night before, put my trade in, and that's it. So it's actually taking out a few levels of stress and taking out, as you said, a few more of those antacids from my life.
Exactly. So we're looking at algorithm 2, which had a 3% drawdown and a almost 11% maximum draw. It's got lots of black and a couple of reds, and the net result of all of that is $1,000 in profit. So if we look at your trade analyzer, we see 4 winners and 2 losers. So it wins twice as much as it loses. $387 winning trade versus $253 as a loser. So that's a significant difference. And if you're winning more than you're losing, and the averages are greater than for winners than losers, then it's like, okay, well, this looks pretty robust to me. There's nothing in what I'm seeing here that makes me nervous. And if we look at the trend analyzer for this, we see in Apple right now, it's actually, so you would be short. So it's in a 2-day short. And if we look at the trend for Apple, and we always in the banner tell you what you're looking at. So this is the trend for Apple. This is the trade details for Apple too. So you know this is relative to the model, but this is relative to the stock. So we're in a 2-day downtrend. There was a 41% chance that Apple was going to go down 2 days in a row. It did. Now there's a 50% chance that it's going to go down 3 days. But then if it gets to 3 in a row, there's only a 25% chance it gets to 4 and a 14% chance it gets to 5. And it's never been down 6 days in a row. So if this is where we're at, 50-50 that it gets another day, it's 2 days old already. The average number of days in a win is 375. So this would be the 3rd day. It's almost at that average number of days. So this might be a compelling reason for you to say, all right, it's too late for me to get into this because it's already 2 days long. I'll wait for the next long trade.
Wait for the next flip. Thank you so much.
This was really cool today. We covered a lot of ground. I think in summary, what we looked at was how do you find things that are profitable? Day 2 now is how do you find things that are profitable, but that aren't overly risky? And how do I time my entries into? And what that does is it answers the 2 questions we talked about before. We're dealing with the greed or the desire to be profitable, but we're taking away the fear, which is the risk of being in those stocks that inherently have a lot of risk because of the way they're trading during this period that we're looking at that you set when you first started. And that's really important because all of these metrics will change if you choose a different date range because momentum changes from day to day for stocks. And if you pick a different model, Rachel likes 2 in this case. Normally she picks 11, but 11 wasn't very good for Apple. So maybe this will be a 2 for a while. ATVI will be your 11. You'll trade them both and you'll say, well, 11 really does do better over time. It made some money on 2s, but those 11s look good, but not if they lost money when I looked at them the first time. You're going to find that out depending on how it goes for you over time.
Thank you so much.
You're welcome so much. Part 3 we'll do at some point, and what part 3 is going to do is it's going to look at this guy, risk analyzer, and this guy, the data. That's a little tease as to what's coming up. Until next time, thanks for being here. Thanks for everybody who's watching this now. And I hope
wait, I have to put in my physical therapy thing. Everybody who's been sitting and watching this should really get up and do some stretching and movement, including you and me right now, John. Absolutely. So I'm going to have to put in a plug for not only just physical therapy, but Midtown Physical Therapy in New York City.
Absolutely. Because if you do live in New York City, or if you are in New York City and you want to see a physical therapist that can do some pretty amazing things for you, Williams is your person.
Thanks, John.
I'll tell you from personal experience.
I'm really looking forward to managing my finances with stocks. And so for me personally, I'm actually really looking forward to the next session. So thank you so much.
Well, I'm hoping the thing that this has showed you is that it seems a little daunting at the start. The way we present the data is not that hard. The data we give you, it's not that hard to interpret if you just understand what the words mean.
Overall, this doesn't really require much resources of my own as far as time effort.
No, you hit the nail
just
on
to
the
keep
head.
it simple.
The interface is so simple that once you master the 8 boxes that will pop up on the screen, you're the master.
Thanks, John.
And that's it for Traders Freedom One-on-One session number 2. Please let us know your thoughts and your feedback in the comment section below. Click like if you learned something from this video and enjoyed what you saw and heard. Click subscribe if you really liked it so you don't miss any new one-on-ones. Click that notification bell if you want to be notified as soon as any new Traders Freedom videos are posted to our channel. And if you do like us and you do decide to subscribe, please tell your friends about us too, because there's more than enough great trading opportunities on tradersfreedom.com every day, and because they're your friends. And isn't that what friends are for? Thanks for watching, and bye for now.